All right, let's get right into it. Today, we're taking a hard look at the trade desk. You know the story, right? The revolutionary ad tech leader, the visionary CEO, this generational shift in advertising. It's a fantastic story. But I'm telling you, right now, that beautiful story and the cold, hard reality have split apart. And we need to talk about what's really going on. So forget everything you've heard for just a second and look at this number 18%. This is the kill shot. While everyone talks about the trade desk like it's some kind of hyper-growth rocket ship, its actual financial speed is, well, it's 18%. This is not the kind of growth its crazy valuation was built on. This one number torpedoes the entire narrative. So this is the real question, isn't it? Are we really watching a generational shift unfold, like all the bulls want you to believe? Or are we actually just seeing a generational slowdown in a company that the market got way, way too excited about? The numbers, well, they're pointing straight at that second option. Okay, so let's really break this down. The biggest problem here, the most critical issue, is this huge gap between the story they're selling you and the numbers the company is actually putting up on the board. This is a classic Wall Street trap, and frankly, it's a dangerous one to fall into. And here's the official story, right out of their own SEC filings. They paint this incredible picture of a significant global opportunity that's just going to keep expanding. And you know what? They're not wrong about the market. Programmatic advertising is the future. That's the story. It's compelling, it's easy to believe, and it's sold a lot of stock. But a rising tide doesn't lift a slow boat, right? And this is the whole problem in a nutshell. The story is a finely tuned race car just screaming down the track at 100 miles an hour. But the company's financial engine, it's chugging along at 18. And when you pay for the race car but you get the sedan, that gap between what you think you have and what you actually have, that's where investors get absolutely wiped out. Which brings us to the stock price. I mean, it's down a ton. And a lot of people are looking at this and thinking, wow, what a discount. Time to buy the dip. This is a huge, huge mistake. What we've been seeing is not a company on sale. It's a desperately needed math correction. I mean, just look at this chart. Look at that insane peak back in 2021. The stock went completely vertical, totally detached from any kind of fundamental reality. It was priced for absolute perfection forever. So that brutal crash back down, that wasn't the market making a mistake. That was the market finally waking up and realizing its math was completely wrong to begin with. So let me be really clear about this. The stock isn't cheaper because this great company is on sale. No. The stock is cheaper because the multiple, the price the market is willing to pay for its growth, has been crushed. The market is just correcting the insane premium it used to pay for that 100-mile-per-hour story that was only delivering 18-mile-per-hour results. But listen, it's not just about slowing growth. It's deeper than that. If you actually bother to look past the hype and you read the company's own 10K, the legal documents they have to file, they're basically telling you about this whole wall of worries that the market seems to be completely ignoring. Let's just run through these quickly. This is from their documents, not mine. They talk about intense competition, okay? They admit to long and unpredictable sales cycles. They warn you about being heavily reliant on third-party cookies, which, by the way, the entire industry is trying to get rid of. They talk about seasonality. And here's the kicker. Insiders have substantial control. Their special stock gives them almost 50% of the voting power. So look, this isn't me being a bear. This is the company literally telling you where all the landmines are buried. Okay, so let's tie this all together and get to the verdict. And it is so important to make a distinction here. This is what separates real analysis from just being a cheerleader or a hater. You have to separate the business itself from the stock as an investment. On one side, you've got the company. And let's be fair, the trade desk is an excellent company. It's a tech leader in a market that is definitely growing, no question. But then you have the stock. And the stock's slowing growth just does not justify the premium price it still has. It's facing that whole wall of risks we just walked through. You have to remember, a great company does not automatically make a great stock. So here it is. This is the bottom line, plain and simple. The trade desk is a great company, but at this price, it's a terrible stock. The risk here isn't that the business is going to collapse. The real risk is in the premium you are still being asked to pay for a growth story that is very clearly hitting the brakes. And I'll just leave you with this one question to think about, and this applies to way more than just the trade desk. Whenever you see a great, compelling story run headfirst into the hard, cold reality of slowing math, which one do you bet on? Because I can tell you, history is very clear on this one. The math always, always wins.